Thanks very much for having me. I was delighted to be invited. And I'm going to present joint work with Joachim Tork from Stockholm Research Institute of Industrial Economics. And Yeshai's comment, where is he gone? About relatedness makes me smile. I was very nervous presenting to this distinguished audience because I don't have a paper on institutional investors. That's the first reason. And the second reason I was nervous is I don't actually have a paper. So that made the life of Eugene Kandel, my discussant, easier because he didn't have to read a paper, but it made it harder because he received a couple of slides 3 days ago. 1 week ago, we didn't know if we have enough results to present. I'm happy that I do have some results, but they're not as many results as many of the other distinguished papers who have forthcoming papers. This is a forthcoming paper in the sense that the paper is only forthcoming, but no publication is forthcoming anywhere near. Okay, still I think I'm going to try to convince you that this is relevant and that it is interesting and important. And frankly, for me, this paper, I've mainly written it because I think it's important. I don't think we've made enough progress to make it a fully rounded academic paper yet. But even if I just convince you that this issue is worth looking at, I think I will have established something. I'm going to look at foreign investments and jobs. And we're going to look at US venture capital coming into Sweden. That's the objective. This is unfortunately a slide I've been using lately a lot. It's not demand and supply, it's a timeline. This is the paper quality. I'm down here, and the value of feedback is up here. So that's your role in this game. Okay, let's start here. This is now 1 year old, but the world is going in this direction. And so if we're thinking, I want to motivate this from a broader institutional perspective. If we're thinking in the world today, I think one of our biggest threats is our perception of trade and our perception of cross-border investing. And this is the direction that the world is going. Now, to economists, this is very frustrating because we take it as obvious that there are benefits of trade. And we take it as a given that, investments across countries is good. But we're getting some serious pushback from the world of politics. So here are 3 quotes. The first one you may have heard. It's a bit general, but it's hard to get more specifics out of this guy. Theresa May is more specific, and here's what she said when she became a prime minister, vowing to protect British business from predatory foreign investors. By that time, she didn't have to get elected. She was actually sort of managed to have a coup where everybody else fell by the wayside, and she was in power. And that's what she promised to do. Well, I don't know, that language scares me. Now, but sort of on a business front, this question of jobs is differently perceived. It's also a question that policy worries about it, but entrepreneurs worry about where the jobs go. There's constantly some tussling about this. So Spotify, arguably Europe's most famous unicorn, $1 billion company, and they keep threatening to leave Sweden. I mean, they haven't done it, but there's all this hustle about where are the jobs, are they staying or are they going? So that's basically the context of what I'm going to look at, because I think, why am I looking at the jobs question? This is not a conference about jobs, but I might still convince you that the biggest threat to investment and the biggest threat to, basically this erecting of barriers to international investments is about jobs. That's what the politicians worry about. So in this research, we want to look at the effect of investment on jobs. Okay, there's a whole bunch. I'm going to give you a broader motivation. Because I have so few results, I can spend more time in motivating some of these broader contexts. So, one of the contexts has been, there's been an eagerness to attract US investments into Europe, Israel. I'll separate Israel from Europe here. Because a lot of them sort of want to create their own Silicon Valley. So the hope is that these foreign investors will bring some direct benefits. That's to say they will directly help companies, European companies seeking US investments to expand, to get more money, and governments hoping for some kind of a spillover effect. What? Oh, I guess that was a problem. I agree. I'll just put it here now. Okay. And presenting this paper in Israel is a particular pleasure because the Israeli experience, if we go beyond the paper, I'm not going to have Israeli data, but the Israeli success story is well known, it is well understood, at least locally, and but it always carries these questions whether this is replicable. The key thing about the Israeli success story is that US investment was incredibly important in jump-starting the tech sector, continues to play an important role, and I'm sure our discussant has a lot more to say about that. Okay, let me give you a different paper. This was my backup plan in case I had no empirical results, but Yishe was very clear in saying, no, rather present empirical results than theory. Well, you said it more politely, but but no, this is useful background. I'll briefly sort of tell you about a different paper of mine where we're looking at how do you promote entrepreneurship. It's a theory paper. I'm not going to go into the details, but in these kind of worlds, you often get multiple equilibrium. The reasons why we get multiple equilibrium in this paper is very interesting, but not of today's interest. But think of a world in which you have some economies with very low levels of entrepreneurship. You're trying to get a critical mass that takes you above this. I'm showing you sort of a state diagram that some of you may have seen. The technicalities don't matter here. But we often have this notion foreign investment is going to be important to take us out of the low and the high equilibrium. In that particular model, we can show you how it works. So basically, foreign investment shifts you from the blue to the green line. That has an immediate effect on any of these equilibria. But the critical thing is the critical mass that you need, the critical amount of entrepreneurship that you need in order for this economy to become self-sustaining actually is lowered by the presence of foreign capital. If you get a lot of foreign capital, the low equilibrium disappears altogether, and the economy is on a path to the high equilibrium. One of the beauties of that theory is it actually makes interesting predictions about the dynamic path. So in the beginning, you're going to rely a lot on foreign capital. And what happens in this model is that foreign capital creates domestic expertise, and particularly it creates entrepreneurs who then become angels. And these angel investors are now domestic, and they start investing in the local economy. And over time, you're becoming more resilient domestically. You rely less on the foreign investments, and you have a chance of moving up to the high equilibrium. So this is a beautiful theory that says foreign investors are going to be very important in taking an economy and lifting it to sort of the international standard or the Silicon Valley kind of role model. So I'm going to give you one other motivation, which is not directly related to this paper, but it is interesting. And it basically says, look, we've developed some of these ecosystems in Europe. And so the top line, but where we haven't developed them is at the later stage. So maybe we're starting to see some of this at the early stages, where early stage angel investors are starting to invest domestically. But when you're getting to the later stages, the amount of money is much larger. You probably need a different expertise for scaling a company as opposed to just starting it. And it turns out that foreign investors matter a lot. If you compare the US venture capital industry, about 70% or so goes into later stage financing. The Canadians have increased that, but Europe is, below 50% of the money is in the early stages. So we're seeing this need for foreign capital, especially at the scale-up stage. It's present at the startup stage, and it's particularly important at the scale-up stage. Here's some evidence from the UK. If you're looking at the role of foreign investors, as you're going out from a seed investment towards higher series, the proportion of foreign investors is very high. So that's just to give you the context of where we might think foreign investors matter. I'm going to have the same data for Sweden. I'm going to focus on Sweden. We find the same pattern here. So let me define the research question. So this was all motivation. Let me now tell you what we're actually going to do. We're going to look at US investments in Sweden, and we're going to create, are they associated with more or less job creation? We're very importantly going to ask the causal question. Is this randomly? Is there selection? There's lots of selection going on in this market. Do we have any reason to believe that any of this is causal? And then the harder question, which we've only started to address, is what about the quality of jobs? Because there's an implicit argument in some of this that maybe if they create jobs, but they're lousy jobs, then we don't want the foreign investors. That's the question we're asking. Is Sweden interesting? Well, you may have your opinion on that one, but that's not what we're talking about. Here is a recent statistics. Now, in all truth, this statistics was released by Atomico. Atomico is run by Niklas Zenström, who's Swedish. So this statistics looks slightly more favorable to Sweden than others I've seen. But it puts Sweden as the number 3 nation in terms of venture capital. At the top, I'm delighted to say, Israel has the highest proportion of venture capital to GDP in the world. That's the well-known fact. The USA comes second. And here Sweden is third. I've seen other statistics where they come out 5th or 6th, but it doesn't matter. It's not a well-known fact, but it is a fact that Sweden is actually a very strong country in terms of venture capital. It's a small country, but they're doing relatively well on venture capital. Okay, so here are 2 theories. Theory number 1 is the very sort of positive, I mean, these are verbal theories, but very positive theory. US venture capital, they have greater expertise, they have deeper networks, and so this encourages the domestic growth in Sweden. Lay all your jobs on me. I think that's an ABBA song. And the other version of this is basically, well, no, foreign investors are not interested in Sweden. If they make an investment, they have absolutely no interest in the domestic economy. They're going to try to relocate jobs to the US. They have no qualms about terminating companies that are weaker. And so it's so long, see you, honey, your job's gone. So those are the two arguments. And I mean, these are not even theories, these are rhetorics. And our job as economists is to put some data behind this and tell us, which of those effects is true. Now, these, by the way, also give you a hint about some of the more subtle questions about under what circumstances would we see job creation or job destruction. We haven't gone there yet. That's on our to-do list. But for the moment, we're starting just with the most important question about is there job creation or job destruction. Later on, we would love to get into the refinements under which circumstances it happens more or less. Okay, what are our results? Well, our results, and they are new and they are interesting to us, is that actually this suggests that US investments are associated with higher employment. So the alarmist theory does not seem to hold, at least not in Sweden. And very interestingly, the effects do appear to be causal. And so that I'm going to spend a little bit of time in trying to convince you, see if you believe my instrument, see if you believe the evidence. But this puts a very, very positive light on it in the sense that, it does really seem that these investors are bringing something to the Swedish economy. And we're only measuring jobs in Sweden deliberately. There may be other jobs that are created in the US. They're not visible to us in our data. Okay, and there's a whole bunch of literature on foreign and domestic investments, a little bit on venture capital and jobs. I think I'm going to talk a little bit about the data. The data, our main source for venture capital is Thomson 1. That's the standard workhorse in the literature. This is the beauty. Why do you work on Sweden? Because in Sweden you have very beautifully accurate, detailed data on jobs. So if there is somebody working in Sweden, Joachim knows about it. Because he has it in his database. In addition, the Swedish data, there's subtleties between the Norwegian, Swedish, and Danish data, but the Swedish data has both good individual and corporate data. So we have very precise accounts of number of full-time employees in all of these companies at any point in time. We have things like very precise bankruptcies. We know when companies are actually liquidated. We know when they exit. There's a whole bunch about group structures and complexity that Joachim can tell you much more about it when he's around, and I will skip that. Our main sample is basically 1998 to 2012, and we're going to start tracking companies at the first VC investment. We could go further back, but it doesn't make much sense. We're going to go mostly until exit. Exit is IPO, acquisition or bankruptcy or failure. In a few cases, we're actually going to go beyond exit, which is very exciting, but I'm only going to do that towards the end of the presentation. Okay, some descriptive statistics. If you just look at the raw statistics, you find all sort of differences. And I mean, basically, the foreign investors are in companies where there's more employees, more employment growth. Wages are very similar. They get more new rounds. They get larger amounts of funding. They get more exits, fewer failures. So in the descriptive statistics, everything looks better for the US than for the domestic VCs. Oh, let me say one thing I haven't made clear here. For this analysis, for various reasons, we're really focusing on the US investors into Sweden. Now, there are other foreign investors, non-US foreign investors into Sweden. For the moment, we essentially dropped them for the sample for most of the analysis. We looked at them. There's nothing particularly interesting happening with them. And a lot of the foreign investors that are not US are actually Norwegian. So they're, it's just the next door. So we think they might be more similar to the Swedish anyway.
What's the split, Thomas, between 5,000, or the split between US and non-US?
So we have about, I think, it's a good question. I don't know my descriptives as well. But I think we have sort of between 10 to 20% of deals that have US investments and maybe another 5% of deals that have non-US foreign investors. And those are the ones that we're moving. So US is still by far the largest foreign investor in Sweden.
Are there local VCs?
Yes, there are lots of local VCs. Well, that's the comparison. Yeah, the base category, 80% or so of the deals Sweden does have a real venture capital industry, and so there are a lot of Swedish venture capital funds who fund these companies. Absolutely. Okay, what's my empirical model? This is not supposed to be super complicated. An outcome measured at t+1. We haven't played around with the time structure yet a lot, but that's on our to-do list. But we're going to look at the presence of a US venture capitalist investor, a number of controls. What are the outcomes? The outcomes are, well, we focus on 3 employment outcomes: level of employment, growth of employment, net job creation. And we then look at a couple of financial outcomes, whether they're going to get a next round in the next year, whether that's a foreign round, that's a natural thing to look at, how big are these rounds, and then the 2 standard measures that we have in the venture capital industry: exit as a measure of success and failure as the opposite. In between is obviously the alive category. This is fairly standard for those of you who know the venture capital industry. The controls are fairly standard too, so I don't think I need to go into too much detail. We do cluster by company. Clearly, this is a panel data, so that is absolutely essential. We've done a little bit of double clustering. It doesn't seem to matter at all. But here's the big issue. Obviously, the presence of US is endogenous. So, we're very aware of that and basically didn't want to present unless we have something to say on this. So I'm just going to skip the OLS regressions because I do want to tell you about the instrument. So yes, we're going to find effects in the OLS regression, but we really want to look at the causal effect of US venture capital. And so we have a very simple instrument to propose, which is there are well-known cycles to fundraising in the US. They go up and they go down. They are driven by all sort of dynamics. Other great people before us have looked at fundraising of US funds being a function of local variables and national variables. And that's all wonderful. It doesn't really matter to us. The only thing that matters to us is US fundraising driven by Sweden? And the fact that you're laughing gives me my exclusion restriction. Basically, it says, well, these variations of what's happening in the US are going to affect the pool of money that's available in the US, some of which will spill over. In fact, a small fraction of it will spill over to foreign investments, a small fraction of that ending up in Sweden. But it's not that US investors are going to their institutional investors and saying, give me more money because there's something hot happening in Sweden. That is really all that I need for this instrument. So informativeness now, is there a relationship between US fundraising and US investments in Sweden? And this is my basic graph. This is just a graph. It's not a regression. But it does clearly suggest that the more fundraising there is here, the larger the proportion of US investors in Sweden. So what you have on this axis is the amount of fundraising in the US. What you have on this axis is the percentage of deals that involve US investors looking at Sweden. So, so this is just a plot diagram for period 1998 to 2012. No, thank you. We're doing it just as we're doing it in the regression. This is in year t+1, and this is in year t. But you can do it with different intervals. But since we're going to use that in the regression, this is year t, this is year t plus 1. Now this is just a plot diagram to say, well, the data suggests it is going up. And the exclusion restriction is, does US fundraising directly create jobs in Sweden? No, it's going to create jobs through the foreign investments.
What's the frequency of the data?
So, well, annual fundraising, we have it at the quarterly level. For the moment, we're aggregating everything into annual because our employment data is mostly at the annual level, and so everything is aggregated to annual level.
How do you deal with the fact that there can be a technological shock so that the determines flows in the venture capital industries and lead to growth of employment in Sweden and in the US?
Well, let me see if some of my other controls deal with it. To some extent, the question is how correlated would they be between Sweden and the US, right? I have to think about that. I'm also getting a lot harder time than any other discussion, any other paper. We will never get interrupted. And our poor discussion is going to be out of things, but it is a good point. Yes. I don't mind, I actually enjoyed this a lot. So I don't mind at all. I have to think about the technology. So what? Good point. You got me. Okay, let me show you the key thing. I guess I did. You're right. Okay, so now we're going to run the instrumental variable. The standard is that your instrument should be significant. We have a T of 3, so that's actually a very large T. So, our fundraising does very strongly predict investments into, into Sweden. You're supposed to have a F statistic of 10. So if you round up 9.507, it comes out to 10. No, actually, to be honest, I'm worried. My main worry is that I have a weak instrument. I think I have a valid instrument. It's just I don't think it's a very strong instrument. And I think that is a concern. Let's see. Normally with a weak instrument, what you get is lots of insignificant stuff. That's often the pattern. Yes?
Just to understand, you have time series variation only. This is what you're exploiting in
Yeah.
your interest.
Yeah.
So there are no year fixed effects in your regression.
No, that's a very good question. Because I'm using it, I'm using various trend controls, and maybe a technology shocks will be another trend control, but you cannot. Because, yes, and that's the weakness of the instrument, it is year fixed effect. I'll give you a second one that adds a little bit of something to it, but I cannot use year fixed effects because mechanically we've taken out this frequency here. And that is the weakness of the instrument. The weak instrument is an issue that we're definitely here. But let's look at the results. Well, the results are actually very strong. So we're finding basically significant positive effects on job creation, and we're finding significant effects on new rounds, and the exit effect, failure is not significant. It's positive, meaning there could even be more failures, but it's not significant. Exit is positive. So a little bit on this. I am worried about the strength of this instrument. And so one of the things we're going to do, again, I'm going to speed up, is we are going to interact our instrument with distance to airport. The idea here is that we want to get to some kind of cross-sectional variation, something else than just here. And we would think that shocks in the US are going to matter more for companies located close to airports. And Sweden is a very large country, and we do find that the foreign investors disproportionately invest in a proximity to an airport. We can then rerun our instrument, and we're getting very similar results. So it's a step towards it. Okay, I want to spend 2 more minutes. 1 more minute on what I think is the second big question that we just started looking at. We don't have an instrument for this question, but we want to know whether, other than investments, do exits, acquisitions, and IPOs affect the job? Now, this requires us to go beyond the exit. I'll just show you very quickly the results because they are interesting. There's a little bit of something going on. So exits by themselves don't seem to create jobs, don't seem to destroy jobs. But there is here now, this is marginally significant, and this is a correlation, not a causation. But it does seem that even though there's sort of the levels of employment are there, there's a bit of a slowdown after foreign exits. So this is the first indication that You know, I want to be balanced. I want to say, you know, is there true? Should we worry about it? Foreign exits, not investments, maybe cause a very small alarm bell. We need a lot more work to figure out how strong and how important this effect is. The second thing that we do is we look at data on individuals, and we're trying to figure out what happens to individuals' careers in a venture capital firm that receives a US investor. So this is a different data set, lots of things that we still have to work on, very preliminary work. Here's sort of the trend lines and the levels of wages of individuals. Now, we deliberately focused on those individuals who worked in a company before the venture capital came in, right? And then when comparing if foreign or domestic venture capital comes in, it does seem that on average the wages are higher in companies with foreign venture capital. Now, that could be a selection effect. It could also be something else. The trend, though, is flatter. So you're looking at the differences in trend. There's a little bit of a notion that the careers, the wage profiles of the people who work in these companies with foreign VCs is slightly worse. How worried should we be about this? We don't know. If we look at labor income, it's there. If we're adding capital income into it, the effect is essentially insignificant. So basically what we're trying to do is we're trying to look at the quality of job by looking at the career path of individuals. The results are so rough at this point that there's a very, very minor indications that maybe there's some slight negatives, but they can't be strong, and depending on how you look at it, they're significant or insignificant. And another curious thing that we don't understand yet is the rate of entrepreneurship. People basically starting their own company seems to be lower for those that receive foreign venture capital. Since I am out of time, I will not conclude, but let my discussant take over.
All right, thank you very much. To make a confession, this is the first time in 8 years that I'm doing a discussion. So I should get a beginner's discount. That's one thing. I mean, for those of you who don't know me, I've actually spent the last 8 years, 6 years. First, I was the economic advisor to the Prime Minister and head of the National Economic Council of Israel. I did do some research due to my good colleagues who were carrying me during that time. And in the last 2 years, along with my university affiliation, I'm actually the CEO of a company which is called the Startup Nation Central, so which promotes innovation. So my connection to this session or to this conference is I have a lot of people that that I knew over my 20+ year career. Two, that I've written a paper on VCs with Harry here about 10 years ago. Three, that I've written 2 papers on Swedish IPOs and investors about another 10 years ago. Actually a little bit less. And then the last one is that my organization is financed by one of the most well-known activist investors who's from Elliott Management. So that's my basic connection. Other than that, it's all improvisation. The second excuse is that I'm actually not there, but I'm here. Okay, because you're here and I'm actually a little ahead of you because some of the stuff that you've seen, I've seen the first time 3 minutes ago. So it's like Thomas said, it's really easy job, a really hard job, because I really doubt that I'm going to give a lot of value. So I'm just going to placate myself. I just want to manage expectations with this. Let's move on. So there's a bunch of different things, and you can, at this stage, basically I can't be very helpful on the empirical side. So I did read the paper that Thomas sent me, the theory paper, so I'm going to comment a couple of comments on that. I'm going to talk more about sort of motivation and some of Israeli experience, because that's what I know well. I mean, I've been studying it for the last few years, and I've actually actively involved in it. So it's a very interesting topic, and it says there how countries want to emulate Israeli experience. Actually, nobody thought, in this country, nobody thought that Israel could emulate Silicon Valley if you were to ask somebody in the late 80s that Israel's main export would be software, they would laugh at you. At that time, we were exporting, some potash, some diamonds. Diamonds was actually the biggest export. We were actually importing them and exporting them. A little smaller, actually. Well, we were not stealing. We were just shaping them. And then there was some weapons, some oranges, etc. So last year, our cybersecurity exports exceeded our military exports, which are pretty sizable. So this is just one aspect of software. So nobody actually expected that. But the interesting thing, I've actually saw that, is that when the book Startup Nation, which we actually own the rights in most of the world apart from US to that trademark, came out, everybody was very surprised. And so people started coming into Israel and asking, how the hell did you do it in this, strange place in the world, which was not known for many other things, but not necessarily the innovation. And then essentially prompted a lot of other places asking themselves, if they can do it, why can't we do it? And so Stockholm is the one place, by the way, which has a very interesting hub of innovative community. I'm going to have to say something about your graph later on. So Israel, a very short bit of history. Israel had all kinds of existential challenges over the last 100 years, had to solve them in an innovative way, because if we were to solve them in a standard way, we wouldn't probably be standing here. And so that created a lot of capabilities. And then these capabilities in the last 15 years started moving laterally. Okay, so we had to solve our problems with ICT, in intelligence and other places, with big data and learning and all that stuff. So now we suddenly moved into fintech, in digital health, and the predictive maintenance of industrial equipment, even though Israel doesn't have industry. So we actually quite large in some areas which are surprising, and actually getting a lot of VC capital as a result. So that's basically on 10 sentences. The theory paper actually hinges, this whole shape hinges on the fact that the early investments in innovation are done by former innovators. And so former innovators, and the dynamic comes from the fact that the early innovators, first of all, their numbers are important to be the next period successful innovators who can finance the next round of innovators, but also how much they actually got for their innovation. Because if most of the capital of the fruits of their innovation were taken by investors, then they don't have much capital, even there's many of them. And so you have interesting dynamics in that, which allows you, so if you're too small in some sense, you slip back, because the price is determined by how much investment there is. And so these period investors are greedy as much as the previous period investors, and so they're going to get a very high proportion of your companies, and so you're not going to have much left. But this whole thing hinges on one assumption, is that the only capital that is available for early stage investors are the people who were innovators in the previous period, and they actually pay for that. It does not account for the fact that if we know that these innovators are good in identifying companies, why wouldn't we, in a variety of ways, co-invest with them? Okay, if you co-invest with them, then this whole thing sort of disappears, and so the role of the government is less clear. So this paper asks whether you want to fund investors, or fund innovators, or help them found companies. Okay, so that's the story. And so the interesting thing, I mean, last week I was at a conference where I was arguing for a launch of a fund which basically co-invests with a serial entrepreneur who's very famous. If you use Waze, this is a guy who founded Waze. So he has now about 8 or 9 consumer companies which basically solve all our problems in day-to-day life roughly in the same way. Hopefully some of them will be. So that thing makes it actually introduces separation between the amount of money that he made and the amount of money that he can invest directly through founding. He actually found some companies, so it's a mix. So the one thing that is very important, though, and it doesn't, and it's not in the paper because it's it's an overlapping generation paper, but it's one period, is that one thing that Israel has to teach the world, perhaps, is that the continuity of financing is extremely important. Okay, it doesn't matter how much total amount of financing there is, if it's concentrated on one stage, it's actually not going to be very useful because people are investing in order to pass their hot potato to somebody else. And so the continuity and the knowledge that the continuity exists is extremely important. We actually had a very bad outcome in the 2002-2003 crisis, which basically Sarbanes-Oxley removed our standard way of later stage investment of going to NASDAQ, and then it almost killed the industry. So that's very important. The other thing is that I think the prescription should be context specific. This is still about the theory paper. If you look at Israel, you had shortage of funds in 1993. You had a very good intervention, which is something called Yuzma, which the government basically brought in with $80 million intervention, which were paid back within 3 years, brought in 10 VC funds with foreign expertise. They actually brought the expertise rather than the money. Because that's another interesting thing. What are you bringing? Are you bringing the money or you bring the expertise? Because the money you have locally. I mean, Swedish pension funds have enormous amounts of money, so they don't need US investors. Whereas in 2001, there was no intervention, the M&A market took over. And so that started investing, and because M&A provided the continuity, the VC was in, and the VC funds came in. On the other hand, Singapore intervenes with funds dramatically. I mean, the big scale intervention, very, very little results to show for it. So I'm not sure that it sort of uniformly result uniformly. Another thing is that a different reason for government intervention in financing is actually to reduce the risk, where there's enough money, it's just not profitable for private investors to take so much risk, and that could explain the intervention on the funding. It's the same result sort of through the funding, but it's different stage and different logic. I'll skip that. Okay, so now about the results. So what do we have here? We have basically, it says that if there's exogenous shock to investment of US companies, whether new investment or stock of investment, flow investment, there are various things that they test, there will be an increase in the employment of Swedish sort of young companies in the next period. Okay, next year, right? So I was trying to figure out what does this mean. And so one of the things that you can say is that these are only US companies, right? US investors. And there's not that many of them. So there's a relative small number of companies that they invest in relative to the total. So what if they are focusing on companies that can have a large market in the US? Okay, Spotify is a great example. Okay, why would the US investors invest in Spotify? Because they can actually, they have the connections, and so the question is whether if you have, let's say, 10% higher or 30% higher overall investment or funds raised in the US in 2013, in 2014 you're going to have, let's say, 10 or 15 or 20% higher investment in companies, so maybe there will be one company that will be affected, okay, a few companies that will be affected. It's actually a small number of companies on the margin. And so perhaps these companies on the margin, they're actually looking at exactly those companies that they potentially can have a US market, and in order to scale in the US market, they have to increase the employment, right? Because they hire more developers, they hire, that's because in order to scale, this is not necessarily development of technology, this is a scale up. Okay, you need marketing people, you need This is employment in Sweden, so it doesn't take into account the salespeople who are in the US, but it probably does need to have customer support, etc., people who do know the technology. So my only question is that whether to what extent that actually extends as a general result to other companies. So as a statement that in generically US involvement increases job creation. Okay, US VC involvement increases job creation if they randomly invest in a company. The second thing is that I would like to ask you is why are jobs important? Okay, and that's something that I'm dealing with on a daily basis with the government, with the industry. Is actually one of the big things that we are facing now is a huge shortage of technical people. And the fact that they increase the number of technical people that they employ is actually bad news for us rather than good news, and pretty soon will be for Sweden as well. Because what happens is these companies, if they take the company and they basically split it in half or in whatever partition and keep the engineers and developers in Israel or in Sweden and then take all the other jobs to United States, then what you've just done is you increase the employment of people who had employment to begin with. Pretty good one. And you basically dropped everybody else to hang out dry, right? And so that's a problem because that actually creates a bifurcation in the society, because that means that innovative economy has no connection to the rest of the country. And in Israel, we are on the forefront of that because we have 10% of the working population in that industry, which is completely disconnected from the rest of the economy. I mean, literally completely disconnected. Any parameter you take, it's not related whatsoever. And so the question is, how can we think about it? What's the right metric for what's good? And so one of the things is that last week, again, this is very topical, because last week there was a discussion in Israeli Knesset of whether we should continue to provide tax exemptions, as usually done for funds that are taxed at their origin. And so whether we should provide tax exemption to foreign VC and PE funds, there was a huge scandal. And people were saying that the government in general, or the public in general, is constantly torn between the splitting the pie and increasing the pie. And now we're in the stage in Israel where it's all about splitting the pie. The pie seems to be constant. And this industry is incredibly movable, but at least in Israel. And so it's a question whether these investors, I actually crowd out Israeli investors who would be Israeli public investors, not necessarily private. Whether they do move companies outside the country, and they don't move the companies because you wouldn't see that because the company stays, they just move all the jobs that you would really want to keep outside of the country, and that's something I think you could test with your IV. And how fleeting are they? Okay, for example, again, very topical, Trump just announced their the tax regime. When the law passes, to what extent we're going to see a sudden fleeting of investors as well as their companies into the United States, which would be pretty detrimental for Swedish and Israeli economy. So those are more, I think, more relevant questions than just the number of jobs. And the last thing is, sorry, but there is a correction. It's actually, I don't know who Atomico is, but they actually underestimated the VC investment by 40% in Israel. So the correct numbers we have, in 2016 we had $4.5 billion invested in VC, 8.7 million people. So the correct number is 517, which is twice the size of the US and 4 times the size of Sweden per capita. Actually much higher in terms of per GDP because we still have lower GDP. So that's basically my story. Thank you.
I think the ratio of valid IVs to published IVs in finance is no higher than 1%. And I don't like yours either. The issue is VC financing in the US is going to depend on world growth and US growth, which will be correlated with Swedish growth. So unless you control really carefully for US growth, world growth, Swedish growth, projected growth, you've got another channel, which is the funding comes in at a time when growth prospects are good. And so you got to, I would, in terms of IV validity, I would throw lots of, growth and projected growth variables at this. The problem then is your IV strength is marginal, and I think it's going to go down. But I don't know that there's a solution to that.
All right, let's collect a few. Is that right?
Thomas, I'm not fully understanding.
Maybe the microphone, I think, because
Yeah.
it's being recorded, right?
I'm not sure that I understand fully the economics that you are invoking here. So first, a semantic thing. You are not referring to foreign investments. You are referring to U.S. investments. And that will be important for the economics because there may be differences. Because what you were saying, the story, at least I understood, that why would foreign investors help local development is because they are going to help us through developing of financial markets. That is, they are coming in, they are helping angel investors, so on and so forth. They are bringing in the expertise. So then, leading to what Eugene said, this story is very much context related. I don't think that the Swedish financial market is underdeveloped. So if it is not underdeveloped, like if you were doing this in some other country where financial development is low, I would understand it. But Swedish venture capitalists, I think they are quite sophisticated. The financial markets in Sweden are quite sophisticated. So what is it that these US investors are bringing in that you can invoke, and therefore necessarily by having foreign investors going to make the equilibrium better than what you otherwise would have?
You were looking for perhaps an instrument for the exit. So if you have individual venture capital investor data, usually they have a maximum length duration, like let's say 10 years. So if they get near the end of their cycle, their lifespan, they will be under pressure to exit. So.
Oh, sorry, Harry, in the back.
Just regarding the data, do you control for syndication, US and local funds? Because you have data about the transaction, and I assume that a large amount is actually syndication. Then you capture something else.
I have a question.
So, semi-minor point getting to what Bernie was saying. I think that instrument should be optimally weak. Okay? I think, in fact, when they're strong, there's something wrong with the economic theory that backs them up. If anyway, and this relates to what Eugene was saying, if in fact the instrument was strong and it was very easy to figure out that the exogenous variation in capital that completely unrelated to anything, drive, employment, then you'd have to say, what are the constraints on all the substitutes that don't do it in the first place? And so the hurdle economically to come up with an explanation that backs up the instrument, this is true for any instrument, rises with the F statistics. So I say, statistically, you want the F to go towards 10. Economically, you want it to be not high, precisely because of what his points about the economics of what was happening, what you would do, precisely because this is an exogenous variation.
All right, Thomas, yes. Oh, sorry, did I? No, so it's back to you, I think.
Okay, well, thank you. First, a big thank you to Eugene for very thoughtful, insightful comments. I agree with a lot of it. There are details about the theory that we can talk offline. Very briefly, if smart investors can scale money with less sophisticated money, the model actually goes through. There's some really interesting insights that come out of that, but I'm well aware of those issues. I mean, I think first, let me focus a little bit more on the empirics. I'd love to talk more about the theory, but since I presented the empirics, I think that's where I should focus on. This hollowing out that Eugene was talking about, I think, is centrally what we're interested in. Now, his suggestion, I think, of focusing on the nature of jobs is absolutely excellent, and it's the direction that we want to go, going into the microdata of not just counting jobs, but saying the quality of jobs, the type of jobs. Because I think that's where, as economists, we can actually provide much more, substantive and subtle insights. I think in order to do that, we still have to go through the first step of counting the jobs. So I think, doing that as a first level analysis is important. Now, I mean, I didn't show you the OLS results because I was so happy to have an instrument. First, the OLS results are very similar. So, the effects are in the data. When we get to an instrument, I think absolutely right, several comments about saying, yeah, we got to control for a whole bunch of other things. I mean, it was very sad to get rid of the fixed effects. The regression by the OLS with and without fixed effect is very similar. So that's a first test that even though some of this is going, it doesn't seem to rely entirely on that. If the OLS was strongly dependent on the fixed effect, I would worry more. That's not the case. But we're going to look at these other competing trends, and unfortunately, that's the world where you can have a never-ending list, and eventually, if you throw too many controls at it, I'm sure my instrument will get weaker. I'm glad to say, though, it seems that everybody worries about the measurement, but I think the principle is still relevant. At least I'd be happy to talk more about that. This question of how fleeting are the foreign investors, that is actually something we started to look into. And I mean, frankly, we just haven't had the time. Very, very briefly, we're getting some first indications that these employment effects are coming out of backing winners as opposed to dropping losers. And there's not much. There doesn't seem to be much difference between U.S. and domestic investors and how they treat losers. And losers is mostly measured in terms of sales growth at this point. It does seem to be that the job creation does seem to be from being able to ramp up the winners in terms of domestic jobs. Now, that's what the data is telling us for the moment. Let me take one or two more comments. Sweden is a more developed market, and I totally agree that the story would look different in Sweden than it would look in Malaysia. It does seem that Sweden and Israel have some similarity. They both are relatively advanced markets. So I guess we have to always be subtle, but the problem is that we cannot do 50 studies on 50 countries about the world of foreign investors. That's why I think Sweden is a very good example of a developed country. I would expect different effects for developing countries. And very quickly, syndication, almost all the Swedish deals, almost all the US deals have a local syndicate partner. So basically, you should never think of them being exclusively funded, but always including the foreign investors. Okay, I think I'll probably stop.
All right. Very good. So thank you, everyone.